You watch an exchange-traded fund bounce around on your screen all day. A massive basket of hundreds of stocks moving in perfect, fluid sync. But have you ever stopped to wonder why it does not just drift off into fantasy prices? The answer is not magic, and it is not a promise from the fund manager. The answer is a quiet, hidden swap that runs all day long, snapping prices back to reality whenever they wander. These funds trade exactly like regular stocks. You can buy and sell them second by second, watching the ticker flash green and red. Yet, incredibly, most of the time they hug the exact value of the underlying assets they hold. That gap between the share price and the actual stuff inside stays razor thin on most days. It looks like a natural law of the market, but it is entirely engineered. That tight link is a mechanism run by a few major Wall Street firms for one simple reason: pure profit. They do not keep the price in line out of the goodness of their hearts, or because of some regulatory mandate. They do it because the underlying math pays them to do it. Whenever the price slips out of line, an invisible alarm bell rings, and the machine wakes up. Today, we are going to strip back the official myth of how these funds work. We will show you the mechanical swap that keeps them from drifting into the stratosphere or crashing into the basement independently of their assets. Once you see this plumbing in action, the intraday wiggles of the market suddenly make a lot more sense. You are watching a real-time negotiation. To understand this, you have to realize there are actually two entirely different markets for the exact same fund. The one you see on your phone or brokerage screen is the secondary market. That is where you and I, and most institutional investors, trade shares back and forth on a public exchange. We are just passing the same existing shares around in a giant circle. On that secondary screen, the price moves strictly based on supply and demand for the fund itself. If a sudden panic hits and more buyers want out, the sheer weight of their sell orders pushes the fund price down. It does not matter what the underlying stocks are doing in that exact millisecond. The screen price is just a reflection of who is hitting buy and who is hitting sell right now. But there is also a backdoor. It is called the primary market, and it operates completely out of public view. Only a highly select group of trading firms is granted the VIP access required to use it. At this backdoor, they do not trade with each other. They trade directly with the fund creator, and they are allowed to swap raw fund shares for the actual basket of underlying stocks, and vice versa. Think of this backdoor as a heavy-duty industrial conveyor belt. It is the central mechanism that yanks the public market price back toward the true value of the fund holdings. It is designed to turn a dangerous price gap into a guaranteed arbitrage trade. When the public market loses its mind, the conveyor belt fires up to restore order, simply by allowing the big players to exchange one form of value for another. Let us define the scoreboards. You have probably heard of net asset value. This is the official, strictly calculated value of the fund. But here is the catch. It is only set once a day, precisely at the market close. It is a rigid accounting mark, a snapshot taken when the closing bell rings. It is completely useless for someone trying to figure out what the fund is worth at 10 in the morning. Because the official mark is so slow, there is also a rough running estimate published during trading hours. This is known as the intraday indicative value. It acts as a live tracking signal. For many major funds, this estimate is recalculated and broadcast out roughly every 15 seconds. It gives traders a baseline to see if the fund is trading rich or trading cheap compared to the real-time value of its holdings. Traders stare at that 15-second estimate to spot any emerging mispricing, but the published estimate itself does not force the price back into line. A number on a screen cannot buy or sell shares. The real fix, the actual gravity that pulls the price back, is the primary market creation and redemption machine. Without the ability to physically swap the assets, the estimates would just be meaningless numbers. A quick note before we dive into exactly how this trade works. If you enjoy clean, hype-free explainers on how the underlying pipes of the financial markets actually function, take a second to hit subscribe. We do not do stock picks or daily news here. We just break down the mechanics. There is a lot more like this on the channel. Let us meet the exclusive firms that actually operate this swap. In industry jargon, they are called authorized participants. You can just think of them as the market makers. They are typically massive, heavily capitalized broker-dealers and high-frequency trading shops. We are talking about major institutional names with the balance sheets required to move tens of millions of dollars in a single heartbeat. These firms sign highly specific, legally binding contracts directly with the fund issuer. That piece of paper gives them a superpower no retail trader has. It gives them the right to create brand new fund shares out of thin air, or redeem existing ones and destroy them. But they can only do this in massive bulk orders, trading underlying baskets for shares and shares for baskets. Here is the most critical thing to understand about these trading desks. They only execute these swaps when it is profitable for them. They have absolutely no legal or moral duty to step in and rescue a falling price, or keep the fund on its peg. They are mercenaries, not charities. If the underlying market gets too chaotic to reliably hedge their bets, they simply step back, cross their arms, and let the price wander. The reason this system works so efficiently on normal days comes down to sheer scale. The very first United States exchange-traded fund launched back in 1993, tracking the broader market. It established a standard block size for these primary market trades, known as a creation unit. The standard size was set at 50,000 shares per block. You cannot show up with 10 shares and ask for a swap. Let us do the math on that scale. If a broad market fund trades at $500 a share, a single 50,000 share creation unit represents a $25 million block of capital. Because the block size is so massive, even microscopic price discrepancies become highly lucrative. Big size makes chasing tiny, fleeting mispricings worth the immense technological effort. Furthermore, these market makers only pay a very small, flat administrative fee to the fund issuer to process these creations or redemptions. It is usually just a few $100s per transaction. When you spread a $500 fee over 50,000 shares, it comes out to a tiny fraction of a single penny per share. The transaction costs are basically a rounding error compared to the arbitrage profits they can extract. Let us walk through the exact mechanics of a premium trade. Imagine the public market gets overly excited and aggressive buyers push the fund price up to $100 per share. But the trading desk looks at the intraday estimate and sees the actual stocks inside are only worth $99.50. The fund is trading at a 0.5% premium. That is a glaring gap. The trading desk instantly swings into action. First, they short sell the expensive fund shares at $100 in the public market. In the exact same fraction of a second, they buy the slightly cheaper underlying stocks that make up the basket for $99.50. By holding the short shares and the long stocks simultaneously, they have completely hedged their risk and locked in that 50-cent spread. Now they have to settle the books. They take that basket of underlying stocks they just bought and deliver it through the back door to the fund issuer. The issuer accepts the stocks and hands them a freshly minted 50,000 share creation unit of the fund. The trading desk then uses those brand new shares to perfectly cover their short position. The 50-cent spread becomes pure, risk-free profit, minus their tiny fees. This trade does not just enrich the trading desk, it actively fixes the market. By short-selling the expensive fund, they add supply to the public market, which naturally pushes the fund price down. At the exact same time, by buying the underlying stocks, they add demand to the stock market, which pushes the basket price up. The gap rapidly closes from both directions until the premium is completely erased. Now, let us look at the reverse scenario, the discount trade. Suppose the market panics. Sellers dump the fund, driving its price down to $99. Meanwhile, the actual underlying stocks are holding steady at $100. The fund is now officially cheap relative to its assets. The trading desk sees this and immediately steps in to buy the heavily discounted fund shares in the public market. They accumulate a massive block of 50,000 shares and take them to the issuer at the back door. This time, they demand a redemption. The issuer takes the cheap fund shares, retires them, and hands the trading desk the underlying basket of stocks. The desk immediately sells those individual stocks on the open market for $100 apiece. Once again, they capture the spread, and the buying pressure on the fund pushes its price back up. Because these trading firms are constantly competing against each other, they do not wait for a 50-cent gap to open up. In highly liquid, heavily traded funds, they will fight over a gap of a single penny. At a $500 share price, A one-penny spread is roughly 0.001%. The competition is so fierce that everyday retail investors rarely ever see the fund deviate from its true value. You might wonder why some of the smartest mathematicians on Wall Street are fighting over a single penny. Again, it is the sheer scale of the creation unit. If you have a 1-cent edge on a 50,000 share block, that is a clean $500 in profit for a trade that takes milliseconds. Do that hundreds of times a day across dozens of different funds, and those pennies pay for a lot of trading desks. This system got a massive efficiency upgrade in 2019. The Securities and Exchange Commission adopted a sweeping new regulation covering exchange-traded funds. Before this rule, trading desks usually had to deliver or receive a very strict, exact slice of every single stock in the index. The new rule broadly allowed for something called custom baskets. Custom baskets changed the game. It meant a trading desk could negotiate with the issuer to hand in only the specific bonds or stocks that were actually liquid and tradable that exact day, instead of hunting down a perfectly proportional slice of illiquid assets. This made hedging vastly easier. Because the desks could trade what was available, the arbitrage mechanism became much more resilient, keeping prices tighter even in messy, slow-moving markets. There was also a brilliant quiet tax advantage to this rule change. By using custom baskets, fund managers could specifically choose to hand off their lowest-cost basis stock shares to the redeeming trading desks. This legally externalizes the embedded capital gains, flushing them out of the fund completely. It means everyday investors holding the fund are shielded from surprise capital gains taxes. It is incredibly dull financial plumbing, but it saves investors billions over the long run. When market conditions are normal, this entire machine works flawlessly. The live intraday estimates broadcast every 15 seconds give the trading desks a clear target. They effortlessly hedge their exposure in real time, firing off buy and sell orders. They run the creation and redemption swap continuously, all day long. The secondary market price stays glued to the primary market reality. The engineering of this system has been continuously refined for more than 3 decades. For calm, massive United States equity funds tracking major indices, the tracking error is almost non-existent. The conveyor belt hums quietly in the background, flawlessly transferring risk and aligning prices. As a retail investor, you barely even notice it is happening. You just get a product that works as advertised. But the system is not invincible, and it is crucial to understand when it breaks. August 24, 2015 provides a perfect case study. Overnight panic led to a chaotic morning open. Dozens of major individual stocks were halted by circuit breakers or fell limit down. Because the underlying stocks were frozen, large parts of the index basket simply could not be priced or traded. Without the ability to trade the underlying stocks, the trading desks could not build their hedges. And remember, they have no duty to be heroes, so they simply stepped away from the market. Market makers pulled their quotes or widened them aggressively. Suddenly, dozens of seemingly safe, boring equity funds were printing trades 10 to 20% below their actual asset values. The liquidity completely vanished. With the hedging channel blocked, the backdoor was effectively welded shut. The link between the fund price and the asset value completely decoupled. But it was only temporary. Once the individual underlying stocks finally reopened and began trading normally again, the trading desks could resume hedging. They stepped back in, captured the massive discounts, and the terrifying gaps shrank incredibly fast. We saw a completely different variation of this break during the severe liquidity crunch of March 2020. This time it was corporate bond funds. Unlike stocks, corporate bonds often trade by appointment over the counter. During the panic, the bond market effectively froze. The official pricing services were relying on stale quotes because no bonds were actually changing hands. As a result, major corporate bond funds started showing massive apparent discounts, sometimes trading 5% below their officially stated net asset value. The media panicked, claiming the funds were breaking. But in reality, the fund prices were accurate, and the underlying bond valuations were wrong. The fund screen price reflected the harsh, real-time level where buyers and sellers were actually willing to clear risk in that exact moment of stress. In other words, the fund mechanism was actually importing rapid price discovery into a completely frozen, slow-moving bond market. The fund only looked incredibly cheap relative to its stated value because the official value was disastrously late to the party. The trading desks could still redeem shares in kind, but they were relying on the live fund price to tell them what the bonds were actually worth. There is another common scenario where the price seems to drift, and it involves time zones. Think about funds that hold international equities, like Japanese or European stocks. These funds trade all day in New York, but the home markets where the actual stocks trade are closed and fast asleep. The underlying assets are completely frozen in time. Because the home market is closed, the intraday estimate can quickly become stale as global news breaks during the New York trading day. Apparent premiums and discounts will naturally widen out because the trading desks cannot perfectly hedge with closed stocks. But the very next morning, when the local markets finally wake up and open, the arbitrage mechanism tightens right back up, the belt speeds up, and the gap vanishes. To really visualize how tangible this mechanism is, look at the largest physical gold fund. It uses this exact same in-kind process, but instead of digital stock certificates, it uses massive physical metal bars. Historically, a single creation unit for this fund tied 100,000 shares to roughly 10,000 troy ounces of actual heavy gold sitting in a secure vault. If the public market goes into a frenzy and bids the gold fund up to a premium, the trading desks get to work. They source actual London good delivery gold bars from the physical bullion market. They arrange for armored transport to deliver those heavy bars directly to the custodian bank. In exchange, the custodian hands them digital fund shares, which they instantly sell into the market to crush the premium. Now, it is worth noting that not every single fund uses this physical, in-kind swap. Many fixed income products, and certainly the newer wave of digital asset products, rely on cash creations and cash redemptions. This means swapping cash for shares, rather than raw assets for shares. It is slightly less elegant and can add some operational friction and tax drag, but the core arbitrage swap still lives on. Even with a cash creation model, the trading desks can still keep the secondary prices remarkably tight. They simply use slightly more complex tools, leaning on futures contracts, underlying assets held by affiliates, and completely custom hedging strategies. The overarching lesson remains identical. As long as there is a liquid, reliable way to hedge the underlying risk, the arbitrage mechanism will work. There are important structural caveats to keep in mind. While a major fund might technically list 20 to 40 authorized participants on its paperwork, the reality is highly concentrated. A tiny handful of elite firms, often just 3 to 5, handle the vast majority of the heavy lifting. In a severe market stress event, if those few key players decide to step away simultaneously, the price alignment can weaken dramatically. Furthermore, fund issuers hold a nuclear option. In incredibly rare and extreme market disruptions, they have the regulatory authority to temporarily suspend creations or redemptions entirely. If the issuer slams the primary market gate shut, the arbitrage machine violently grinds to a halt. If that happens, massive premiums or discounts can persist for days because the back door is locked tight until the market clears. Remember that spread widths, fee levels, and tracking accuracy will constantly vary depending on the specific asset class and daily market volatility. The tight pricing you see is a mechanical outcome of pure capitalism, not an ironclad guarantee. This is why it is absolutely vital to know exactly what your fund holds, and just how easy it is to trade those specific underlying assets during a panic. If you step back and look at market history, this pattern repeats across every asset class. The live ticker price you see on your screen is just a real-time negotiation for immediate liquidity right now. The official net asset value is just a backward-looking accounting of what those assets were worth earlier. The friction between the two is where the market actually functions. The creation and redemption gate exists to ruthlessly arbitrage away any easy money whenever hedging is mathematically feasible. In calm seas with high liquidity, the funds track their underlying assets incredibly tightly because the gate is wide open. But in severe storms, when assets freeze or panic sets in, the hidden swap slows down or pauses entirely, and the illusion of perfect stability breaks. Here is the ultimate takeaway for your own understanding of market structure. This quiet, unglamorous swap is the vital governor on asset prices. A few heavily capitalized players run it for a living. They will happily switch shares for baskets all day long whenever there is a loose dime to pick up off the floor. And they will ruthlessly step aside the exact moment the math stops making sense. That is how financial markets actually work. Not marketing slogans, just cold incentives and underlying pipes. If this mechanism clicked for you, hit subscribe and drop a like. We have built an entire library here breaking down bubbles, crashes, and market mechanics. Stick around for the next one, and we will see you soon.